permanent buydowns versus temporary buydowns. What's the difference? Hello, I'm Emmanuel St. Germain, CEO of Choice Mortgage Group. We've been talking quite a bit about the temporary buydown, and it's the most popular product for buyers today. We've told you all about how the product is a subsidy that's paid by the seller to temporarily allow a payment for a buyer that is based on a lower interest rate. For example, if today's interest rate was 6.5% and we were doing a 2-1 buydown, that means that in the first year, our buyer's payment would be based off of a 4.5% interest rate and 5.5% interest rate on the second year. The rate never changes from 6.5%. The bank simply accepts a payment that is based on a temporary lower rate because the seller contributed that payment difference. Now that seller's subsidy is sitting in an escrow account, which is like a separate savings account, so that as the buyer makes their payment based on a 4.5%, the bank draws the payment difference so the payment is made whole. So the loan was always a 30-year fix at 6.5%. One of the most attractive aspects of the temporary buydown product is that should a buyer refinance or sell their home prior to using all of that subsidy, it's reimbursed by reducing the principal balance at payoff. On the flip side, what's a permanent buydown and why aren't we recommending them now? A permanent buydown can be paid by the buyer, unlike a temporary buydown, which has to be negotiated and paid by the seller. A permanent buydown does not get reimbursed should a buyer decide to refinance or sell their home. A permanent buydown typically reduces the interest rate anywhere from 1/4 point to 1/2 point. So let's revisit the example from above. If today's interest rate was 6.5% and a buyer wanted one permanent buydown, also known as a discount point, that would equal 1% of the loan and reduce the interest rate to approximately 6.25%. This is an additional closing cost, which is going to increase our cash to close. Now, of course, because there are two options here, whether to permanently buy it down or to not, we can create a break even, which is calculated by taking the 1% cost and dividing it by the payment difference, that payment savings. So as a general rule of thumb, right, a buydown is recouped in approximately 4 to 6 years. Okay, so if a permanent buydown is recouped in 4 to 6 years, and as all the financial experts are predicting that interest rates are going to drop back into the 4s and 5s, would it make sense for us to lock into a 6.25 30-year fix that in theory doesn't recoup that discount point for 4 years? It does only when you think rates aren't going to drop. But if the market is suggesting rates are going to drop, that means a buyer will want to refinance and take advantage of those rates. Therefore, right now, in this particular rate environment, we are not recommending a permanent buydowns. Now, there are scenarios based on credit scores and loan to values that permanent buydowns are a must. But if you have a choice, we're going to recommend against it. I know this is a lot to take in. Please make sure to book a call with one of our expert loan officers who can guide you through all of your options. At the end of the day, everyone is different, and a strategy is only applicable to an individual, not to society as a whole. For more great content like this, please make sure to follow us on our social media channels and visit us at choicemortgagegroup.com.